I mean, you can blame one more than the other, whatever. It doesn't really matter. But the fact of the matter is that the Dow lost something like 89% of its value from September 1929 to the middle of 1932. And 9,000 banks went bust on the back of it. This time, the bubble is a lot bigger. It's a record in real terms. Yeah, I think that's fascinating. I don't think anybody's really come up with a sensible answer, and to some extent, it's a bit of a guesswork, but hopefully educated guesswork. The way I see it is that there have been stands for delivery which have ended up spending an inordinate amount of time sitting in COMEX warehouses. This has been the past. So the point about stands for delivery is as they go out of the warehouses, then this is definitely a drain on liquidity in COMEX. We had Trump saying from the outset, 25% tariffs across the board. So immediately there was a panic because the stands for delivery that have yet to be delivered. And you had, if you like, the system had to cover itself so that it could meet those. It couldn't sort of just bluff its way out anymore. Suddenly it had a 25% increase in the price of gold potentially just from tariffs, and it had commitments, down at the international level. So that I think was the trigger for it in a sense. But what has happened also is that with Trump's economic and tariff policies, the rate of stands for delivery has increased very, very sharply. To give you an idea, over the last 4 years, on my figures, stands for delivery have been around about 2,100 tons. So for the whole of the last 4 years. Since the beginning of this year, the rate of stands for delivery, if it continues at the current level, are running at around about 1,700 to 2,000 tons this year alone. So it has increased very, very substantially. We don't know who's standing for delivery. My guess is that it's central banks, again, using this, not the big ones, but the minor ones, probably sovereign wealth funds, that sort of. I mean, there was one day when the stands for delivery were 109 tons, 108 tons, I think it was. And that's $10 billion. Who's got that sort of money to throw around? It's not the business of hedge funds or banks to do that, really. Well, right. I mean, a bank can do it. But banks are in the business of dealing in credit, not dealing in physical, which is why they're always reluctant to deliver physical, which is, because they tend not to have it. They give you a promise, and you can trust their promise if you wish. But the idea of actually storing huge amounts of gold on balance sheet is an anathema to a banker. It's not a sensible use of resources. Having said that, of course, there are changes coming in with Basel III, which I understand from the middle of this year means that gold will be treated as as the most liquid asset, no haircut, whatever, assuming you've got it. Well, you've got it vaulted in somewhere under your control, earmarked for you. So things are changing a little bit on that, but I don't think enough to persuade a bank to get into the, the gold storage, gold ownership business. No, I mean, they're dealers in credit. That's really what they do, which is why, of course, the credit markets are so highly leveraged. Nobody really wants to have the physical stuff. We'd far rather write obligations and receive credit, or persuade people to receive credit instead of the hard stuff. Well, broadly, yes, but it's slightly more complicated than that. I think the portfolio shift adjustment, I'm sure some of that was in there, but it was swamped, if you like, by other factors. And I think that's going to be a feature, if you like, over the next few months, because I have no doubt that the greatest credit risk there is actually is in the credit bubble popping and the effect on equity values, equity share, stock prices. So you're going to get a lot of readjustment, I think, to try and ensure that, fund manager can tell his the underlying beneficiaries of a portfolio that the S&P was down 20%, but don't worry, your portfolio was only down 15%. Haven't I done a good job? You know the story.
Yep.
But actually, I think what was happening, it was interesting because you had this very sharp swing up in the treasury yields and a sharp move down in the dollars trade weighted. And what that was about, quite simply, was foreigners getting out of treasuries and also the dollar. I mean, if you're going to sell treasuries, you're going to sell the dollars as well. I mean, why did you? Unless you're entirely confident in Mr. Trump and his wonderful policies, and it's all going to come right in the end. In which way, it's probably what you do is you might sell your long-dated treasury notes and get into, say, T-bills or something. But basically, I mean, the other factor is that with the world now very definitely being driven into recession, slump, even, on that basis, do you really need to have so many dollars in your back pocket so that you can trade internationally? No.
Right.
So that's I think, going to be quite a source of selling. The other thing is that as the equity market falls further, there is at the moment, on a valuation basis, some $14.5 trillion worth of foreign investment holdings in US equities. Are they going to hang around and watch those values disintegrate? I don't think so. So you've got potentially some huge selling, and it could come in a rush. It's not looking all that good, really. Interests own, according to, this is US Treasury tick figures, $14.5 trillion worth of equities, US equities. And I mean, why are they there? They're there because they think they can, I mean, okay, we can talk fancy diversification or, that's a load of rubbish, really. At the end of the day, the reason you own shares in a foreign market is because you think the damn things are going to go up. I mean, let's cut to the chase. That's what you do. And as soon as you realize they're not going to go up, what do? You get the hell out. And they could be doing it all at the same time when it happens. They haven't started yet, I don't think. But, any technical analyst will tell you that, the S&P has now completed a death cross, and it looks actually bloody awful. So, the message, I think, is, will begin percolating through very soon. Well, I think it's only just started. I mean, you've got two things, Danny, which are working against markets. The first is the biggest credit bubble in history. And anyone who doesn't understand a credit bubble, I'm sure they understand a debt bubble. The credit bubble is the other side of the debt bubble. For every debt, there is a credit. Just look at the amount of debt. I mean, government debt and also zombie corporations and all the rest of it. We can see that prick that bubble, and these bubbles just do get pricked. It's as simple as that. Then this is going to be disastrous. And then on top of that, you have Trump mucking around with tariffs, which is exactly what happened in 1929, because you had the end of the Roaring Twenties, credit bubble, with Smoot-Hawley Tariff Act, which came in, and the combination of those two things, I mean, you can blame one more than the other, whatever, it doesn't really matter. But the fact of the matter is that the Dow lost something like 89% of its value from September 1929 to the middle of 1932, and 9,000 banks went bust on the back of it. This time, the bubble is a lot bigger. It's a record in real terms. And not only that, but if you look at the Smoot-Hawley Mark II, or Trump's tariffs, the US involvement with international trade is far greater. And not only that, but you've got supply chains, which is something that didn't exist in the 1920s. This is really a lot more serious this time. So the idea, I mean, I think that the model, if you like, the 1929 to 1932 model, has the potential to be a minimum expectation of what we see ahead of us. Well, I mean, that is just plainly ridiculous. I mean, first of all, he's just shutting down trade with China Does China care? Well, yeah, a bit. But it's been preparing for this really for the last 10 years, maybe even longer. So its dependency on America has actually reduced hugely. It'll cause a few aches and pains in China. Let's not ignore that. But this isn't going to be a death blow to China by any means. It's more of a death blow actually to America. The complications in this are that virtually every manufactured product which is complex has input from China. So even if it's made in Mexico or Vietnam or Thailand or even in Europe, some of those components are Chinese. So it's going to be interesting to see how Trump deals with that one. If he deals with it on the basis that, you know, the Chinese components have got a 245% tariff on it, I mean, this is just going to be ridiculous. And what he's actually doing is he is driving countries away from America, not just out of US treasuries, but out of America and the dollar as a whole. I mean, this is actually very, very silly on any level. Downright stupid, really. I mean, it's interesting because it's so dumb that so many people I talk to think there's an ulterior plan in the background. You know, there has to be, because this is too dumb. But, you know, I'm sorry, I'm the world's worst cynic. I've seen lots of politicians. I've met a lot over the years. My uncle actually was Chancellor of the Exchequer in the UK back in 1970, briefly before he died in office. So, you know, I met all these guys. They're not that clever. They really are not. They've got some pretty good civil servants behind them, maybe in the permanent establishment, but you know, but basically they're a bunch of idiots. They don't know what they're doing. They rely on advice, but basically they will come up with a wonderful policy which satisfies their voters or a particular pressure group. They feel, right, that's great. You know, we're doing our job. We're looking after these guys and all the rest of it. But then when you get the unintended consequences, then they learn. And it's only then they learn. And they don't know what to do about it when they do learn. Nobody in Trump's entourage actually realizes the relationship between credit bubbles, and tariffs, and the outcome in 1929. And I think if I told them, they'd say, "Well, oh no, that's history. It was all different then. You know, it's different." They don't want to listen. They don't. You know, they're dumb. I mean, you know, there's no further explanation required. These guys haven't got some wonderful agenda in the background, which they're keeping very, very secret. No, they're just a bunch of idiots, not knowing what they're doing.
In this regard,
they're economically destructive, basically.
Right.
I mean, when combined, I mean, sometimes they're not. I mean, every president, I mean, I was talking to Steve Hanke not so long ago about this. I think he advised Reagan, and he was saying that every president since Reagan has basically introduced more tariffs one way or the other. No, so what Trump is doing is he's actually just doing it a bit more aggressively. But it's the credit bubble, which I think is the combination of that with a credit bubble. I mean, we got the credit bubble as it is. This is something which people just don't understand. They've got to understand. What makes a stock price? The amount of credit that is available to puff it up. That's the key point. If credit starts deflating, it doesn't matter how good a company is, the stocks are going down. That is the reality of it. And then, of course, you get the consequences of that because stocks are collateral. I mean, we got margin accounts which total, according to FINRA, something like $900 billion worth at the moment. And of course, the banks take this in as collateral for other loans and so on and so forth. And what happened in the 1920s, as the stock market slid, particularly between 1930 and 1932, banks were forced to sell out collateral because they no longer covered the loans. And, you know, it was just an unremitting thing. I mean, it was just, I mean, Irving Fisher was the guy who actually sort of noticed this and made it a sort of, if you like, a, you know, made the economic community aware of this relationship between collateral having to be sold in a downward market, just making things far worse. It's going to happen again.